Hi there, good morning. You're watching Market Cafe on ET Now. This is a show where we'll take you through all the important global cues, the global commentary that we've been getting in overnight, the global handover, as well as when we delve into the domestic sector and the domestic markets, we'll take a look at all the important cues that you need to be keeping on your radar today, as well as the stocks that could be potential buzzers in today's trading session. But as you could see, spirits are high among cricket fans and they're brimming with excitement for the most anticipated India versus Pakistan match scheduled for tomorrow. After India's splendid performance against Afghanistan earlier this week, expectations from the men in blue are high. India and Pakistan have gone up against each other several times in the World Cup ODIs, and India have emerged victorious in all encounters. Well, all eyes will be on that India-Pakistan match tomorrow, but let's shift focus then and kickstart the show with all the global cues and the global handover that we're getting in. And let's start by looking at what Wall Street has done in overnight trade. Now, stock futures were little changed on Thursday evening as traders are bracing for major bank earnings. All three major indices have ended the day's trading session in the red, with the Dow dropping more than 173 points, and both S&P 500 and Nasdaq have also lost close to 0.6%. Even though the three major averages ended Thursday with losses, they ended Thursday in the red, they are each on pace for weekly gains. So when you look at it from a weekly basis, the S&P 500 is up almost 1%. The Dow is up nearly 0.7% on the week. Now the Nasdaq has outperformed. It's the outperformer when it comes to all of these three indices, up 1% through Thursday's close. Now this is the third positive week in a row for Nasdaq. Second positive row in the week for S&P 500. The Dow is also set to snap a string of 3 straight weekly declines. So the Dow is expected to go into the green when it comes to a weekly basis after 3 straight weeks. Now Thursday's losses came after the latest consumer price index report revealed that inflation still stubbornly persists, pushing bond yields higher. The CPI has risen 0.4% in September and gained 3.7% from 12 months earlier. So on the back of this, you've seen Treasury yields jumped on the back of fresh inflation data to close to that 4.7% mark. Now the US dollar index is also hovering around those 106.5 levels. When it comes to earnings then, Wall Street is going to see a slew of banking earnings today, and it's going to be JP Morgan, Wells Fargo, Citigroup as well as BlackRock. They're all set to kick off the third quarter earnings for the major financial firms on Friday. Now also on Friday, traders will be watching for preliminary consumer sentiment data for October. So this is what the global handover is largely looking like when it comes to Wall Street. Red when it comes to intraday trading, but green when it comes to Wall Street from a weekly point of view. Let's shift focus to Europe then, and European stock markets have closed higher on Thursday as they built on positive global momentum this week. Now, the Stock 600 index has ended with a nominal uptick of 0.1% with sectors spread across positive as well as the negative territory. So rather mixed coming in from Europe over there. FTSE was up 0.3% and DAX has however come down 0.2%. So rather flattish moves when it comes to Europe and negative on an intraday basis when it comes to the US markets. But I'm also joined by my co-anchor Harsh Saita today. Harsh, good morning. Well, this is all happening on the equities front. Take us through crude and other commodities.
Well, yes, good morning, Snehi. Good morning to all of you, and thanks for tuning in. Let's quickly look at where crude is currently. You're seeing largely unchanged on the crude. Even though what we've really seen overnight, or rather the news that's trickled in overnight, is the fact that US has built crude inventories much higher than anticipated. 10.2 million barrels is what they've built up in terms of inventories. There was an expected rise of around 500,000, which is 500,000 barrels. So this 10.2 million barrel rise is definitely more. So there's more margin of comfort. There's more supply, which US has bandwidth for to supply the global crude marketplace. And therefore, what you're seeing is a possibility of a slight bit of negativity on oil. But at the moment, you're seeing oil pretty much in the green, $83.50 a barrel on WTI. You're seeing $86 on Brent. With regard to where the dollar index is, you're seeing 106 on the dollar index on the back of course, the higher inflation. You're also seeing around 10 bips higher on the US 10-year bond yield. So inflation, of course, in focus, and you're seeing asset classes like bonds gain in early trade. What you're also seeing, gold largely unchanged, so no change really there, and therefore, to sum it all up, oil slightly higher despite that crude inventory build up, at least at the start of trade today. Bond yields have gone higher, definitely. The dollar index has risen by around 1% and you're seeing largely unchanged on gold. That's how we're placed.
Absolutely, Harsh. Let's talk a little bit more about the oil markets also. The gap between the world's leading oil forecasters on the 2024 demand growth has widened. Now, the International Energy Agency has predicted a sharper slowdown, while producer group OPEC has stuck to expectations for buoyant China-led growth. The IEA has lowered its forecast in 2024 to 880,000 barrels per day from 1 million barrels per day. By sharp contrast, OPEC stuck to its forecast that the demand will rise by 2.25 million barrels per day in 2024. Now, the difference between the two forecasters is huge, right? It's 1.37 million barrels per day, and it is equivalent to more than 1% of the daily, oil usage when it comes to global oil usage. So, well, that's a wide difference coming in between both of these bodies. So, well, let's see how this pans out for oil.
Well, yes, Right, let's switch over to some positive news, definitely on the Indian macro front. So you saw retail inflation for the month of September. It's come in at a 3-month low at 5.02%. But more relevantly, what was expected was, it was expected around that 5.5% mark. So it's definitely, far lower than what expectations were. And that's on the back of easing food prices. So that's what's really aiding retail inflation at the moment. It's well within RBI's comfort zone of the 2 to 6% band, even though RBI prefers 4% and has reiterated unequivocally that 4% is their target. And reacting to that inflation data, the RBI Governor Shaktikanta Das said that the RBI has worked in close coordination with the government to tackle rising inflation. Listen to that piece.
Effective coordination between the government and the Reserve Bank communication on interest rates, Reserve Bank communication on inflation. I think all these have worked together to ensure that the inflation, which again went up due to a spike in vegetable prices, government took several measures to see that the vegetable prices do moderate, and they have moderated. The latest print has come to 5%, and it is exactly in line with our internal projections. If I remember correctly, I think for the second quarter we had given out a number of 6.4%, and the second quarter number, inflation number, comes exactly at 6.4%. Our internal number for the month of September is also what it has finally come to be, 5%.
Let's also focus on another macro indicator, and the industrial production has jumped to a 14-month high of 10.3% in August. The sharp surge is primarily led by increase in manufacturing activity. The manufacturing sector's output has risen by 9.3% in August, and the same period, mining production is also up by 12.3%. So how will this inflation data and central bank commentary impact the Indian market today? We spoke with experts on the same, and here's an excerpt of that conversation.
FIIs and US investors have been selling equities in Indian market for quite some time, last 1.5 to 2 months. That pace of sale has slowed down definitely, and I strongly believe that at some point of time they will start becoming net buyers in Indian equity. That's one part. But even without that, if you look at what's happening in India, the strength of Indian retail investors, as well as, because of that, maybe not as well, because of that, the strength of Indian domestic institutions have been increasing.
When you have 6 months of the indicators on the negative side, you'll see that we always head for a recession. As far as the inflation data is concerned, we did have some higher top line numbers inflation, but if you look year over year on the core rate of inflation, it was lower, and that suggests that inflation is going in the right direction, and that tells me that we're probably going to see a pause into November.
Right, focus entirely on inflation, and we've got a couple of brokerage notes also coming through. We have the likes of a Morgan Stanley, which is, given a surprise positive note on a CPI. What they said is September CPI moderated more than expected. Moderated food inflation as well as fuel inflation, which is the lowest since December of 2019, is what's aided those CPI numbers. Core inflation is at a 43-month low. Inflation is likely to track the 5% in Q3, so that's another positive coming through. And RBI is likely to hold rates. Now, Morgan Stanley suggests that, and that's again a positive for at least the Indian economy and markets. And what they're suggesting is that the easing cycle with regard to softening of rates will probably start in Q2 of calendar year 2024. Also, you have a UBS note coming through. UBS also very similar commentary. Inflation softens well below RBI's upper threshold, which was 6%. Inflation slows to below the market expectation as well, according to them. MPC is going to keep a vigilant eye on inflation, is what they believe. Rates may be on hold for the rest of FY24, which is also what Morgan Stanley believes. What is aiding inflation? Lower vegetable prices, easing food prices, and the broad-based easing in core inflation, excluding personal care and effects segment, is definitely what's aiding inflation numbers at the moment. So both notes positive with regard to those inflation numbers. Sneha.
Absolutely, Harsh. Let's also stay with macros, but let's shift focus to the US now, because the US CPI print for September has risen at a slightly faster than expected pace, keeping inflation in the limelight for policymakers. Now, consumer price index has increased by 0.4% on a month-on-month basis and 3.7% on a year-on-year basis. Core inflation was up 0.3%, largely in line with what the street was expecting.
Right, and let's switch focus from the other macros to geopolitics. Tensions between Israel and Hamas show no respite as Israel continues to attack the Gaza Strip. The enclave has now been plunged into darkness as its sole power plant ran out of fuel. Conditions in Israel looking bleak too, with cybersecurity threats mounting amid the war, including 2 hijacked smart billboards in and near Tel Aviv that briefly showed pro-Hamas content. 6 days of airstrikes have left more than 300,000 Palestinians in the Gaza Strip homeless. Health officials in Gaza, home to 2 million people, said the Israeli bombardment had killed more than 1,500 people and injured over 6,600 others. The United Nations Humanitarian Agency has announced a flash appeal of $249 million to help the 1.3 million Palestinians in Gaza and the West Bank. Joining US in extending support is UK, which has ordered the deployment of military assets and thereby reinforcing regional stability. Meanwhile, like India, UK has also gone ahead and arranged for rescue operations to bring British nationals out of the war-torn region.
Meanwhile, US Secretary of State Antony Blinken has arrived in Israel in a show of support. The US has also warned Israel's neighbors to not think of taking any advantage. Listen in to what he had to say.
They prided themselves on their self-reliance, on their ability to defend themselves, even when the odds were stacked against them. The message that I bring to Israel is this: you may be strong enough on your own to defend yourself, but as long as America exists, you will never ever have to. We will always be there by your side. That's the message that President Biden delivered to the Prime Minister from the moment this crisis began. It's the message that I and my other colleagues in the government have delivered to our Israeli counterparts on a daily, even an hourly basis. It's the message that I bring with me to our discussions today, and it's what I'll affirm when I meet with the members of Israel's newly formed national emergency government. We welcome the government's creation and the unity and resolve that it reflects across Israel's society.
Right, that was US giving its unequivocal support to Israel. But good news on the Indian front, we have our first flight which has landed from Israel, bringing Indians back home. 200 odd people brought back on that flight. It's landed in Delhi about an hour ago. So that's one big positive also coming through. But let's slip into a very short break. More, of course, on the other side. We'll look at how Asian markets are doing.
Hi there, welcome back, and thanks so much for staying tuned to Market Cafe. This is ET Now. Let's take stock of how the Asian markets have opened up this morning, and well, it's not looking very good when it comes to the Asian markets because all of these major indices are currently in the red. Let's start by talking about China because we're just getting word that China's consumer prices were flat in September, while factory gate prices saw annual declines slow for a third month, underscoring the torturous nature of the post-COVID growth recovery in the world's second largest economy. Now, the CPI index was flat on an annual basis in September. This is what the National Bureau of Statistics has just reported, and this has come in below than the median estimate of a 0.2% increase in a Reuters poll. CPI has inched up by 0.1% in August for the first year-on-year increase in the last 3 months. The producer price index has fallen 2.5% from a year earlier, weaker than their expectations for a 2.4% decline after a 3% drop that came in August. Now, the drop in factory prices was the smallest in the last 7 months. Despite narrowing producer prices in September, the decline is still the 12th straight monthly decline when it comes to an annualized basis. On the back of that, let's take a look at what Shanghai is doing. Shanghai is down almost 0.6%. Hang Seng is also down 1.3% as we speak. Now, remember, yesterday Hong Kong stocks had jumped nearly 2% in the last hour of trading, leading wider gains in the Asia-Pacific region as shares of big Chinese banks had surged yesterday, but it has reversed all of those gains this morning and it is down 1.2% as we speak right now. Let's also shift focus to Korea then, and let's take a look at what Kospi has been doing. And well, all of these indices are in the red. There you have it. Kospi is also down 0.7% as we speak. Shifting focus to Japan then, you will have Nikkei on your screens. Let's take a look at what Nikkei is doing. Nikkei down 0.3% as we speak. And lastly, let's also take a look at what Australia is up to at the moment. Australian markets also down 0.3% as we speak. When we shift focus to home then, we managed to close just below that 19,800 mark for the Nifty. Implied open, you can see it shows 19,691. So well, that's in the red, Harsh. So let's see how our markets open up amid all of these global cues that we've been getting since morning.
Well, yes, absolutely. So you're seeing that the GIFT Nifty at least is reflecting a green as of now, but otherwise you're seeing all negative cues coming through, including the impact of the US CPI probably trickling on Asian markets as well, of course, along with the US markets, and the US 10-year bond yield also on the rise. So a couple of those negative cues coming through, especially from a global standpoint. But let's quickly look at what we have lined up for you on the market. We have a power pack lineup. We have Punita Kumar Sinha, who to start off 9:20 from Pacific Paradigm Advisors. She's going to be speaking to us about how she looks at markets overall at the moment. Then, of course, on to the big earnings, HCL Tech. We have the management there to talk to us about what trends are playing out. Of course, yesterday the IT pack was beaten. Expecting some amount of pessimism on the IT front again today, given the way Infi as well as HCL Tech numbers have come through. Also, after that, we have B. Prasanna as well as Jayesh Mehta, who are going to talk to us about what trends are looking like with regard to macros as well as inflation, as well as IIP. Very solid set of IIP numbers delivered by India at the moment. Let's quickly move on. We have Rajiv Ratan as well from Ratan India Group on the growth roadmap for the group going forward. We also have MK Surana, who's the former CMD at HPCL, to talk to us about how crude is faring and what should one expect in this environment with regard to crude, mind you, complicated global environment at the moment. Also, we have after that Anand Rathi, who's the founder of Anand Rathi, as well as Rakesh Rawal, who's the CEO at Anand Rathi Wealth, to talk to us about the earnings at 10:45 a.m. So we have a really long and a power-packed lineup up for you on the market. Right, welcome back. You're watching Market Cafe on ET now. Let's quickly take you through what's key in markets or what's really moved over yesterday. Earnings season kicked off. Three major IT players announcing their Q2 results. HCL Tech and Infosys were the latest ones. All three of them, including TCS, saw a miss with regard to revenue. And the guidance has also come out a bit weak. But on the margins front, it's been a bit of a beat versus what analysts were really expecting. Let's try and dive into the highlights from these results. Anisha is here with all of those. Anisha, take it away.
Well, yes, the IT earnings are out from three major companies, TCS, HCL Tech as well as Infosys. And if I had to run through a thread to get the consensus, well, the revenue was pretty much a miss across the board. Infosys, of course, surprised positively at 2.3% constant currency growth. But for TCS as well as HCL Tech, it was a bit of a miss. The constant theme this time was, of course, the margin beat, whether it was TCS, HCL or, even Infosys for that matter. All three surprised very positively on the margin front, and that's why the profitability of all the three companies was a beat. Now comes the point of headcount, deal wins as well as growth outlook. Let's talk about headcount first. For TCS, they reported a decline, a sharp decline. Ditto could be said for Infosys and HCL Tech as well. Both those companies reported a sharp decline in their headcount as well. Deal wins have been strong throughout. In fact, for all the three companies, pretty much it's at record high levels, the deal wins. So that's something to write home about. Separately, as far as the outlook is concerned, now there TCS has said that Q3 is not a seasonally strong quarter, so they're not expecting fireworks there. They're not giving a timeline as to when the recovery will happen. For guidance of Infosys, that has been cut sharply to 1 to 2.5% versus 1 to 3.5%, and they are calling out pretty much a slowdown in the second half of the year. A slight differential coming in from HCL Tech when they have cut down the guidance. They've cut it down to 4 to 5% versus 6 to 8% earlier. So there's a sharp cut happening, but the management is attributing it to the weakness that happened in H1. They're actually expecting a strong performance in H2, and CQGR, or the ask rate of growth for the next couple of quarters, is actually 3 to 4%, which they're quite confident that they'll deliver. So overall, for TCS as well as Infosys, it looks like next couple of quarters are going to be weak, but HCL Tech, given it's seasonally strong for them, the Q3, Q4 quarters might be able to catch up.
All right, thanks Anisha for breaking down the numbers of those major IT bellwethers. But let's also get you the commentary from the management of Infosys as well as HCL Tech on their Q2 numbers. Listen in.
We see the impact in telecom, in high tech, in areas of financial services that we'd shared in the past. For example, payments, investment banking. We see some impacts in the retail sector as well. So those are the ones where we are seeing the impact. Of course, we have other industries, manufacturing, life sciences, which are continuing to do well.
This quarter was definitely a very strong quarter across all dimensions of performance. Our revenues grew 1% sequentially and 3.4% year on year in constant currency. Looking ahead, the next 2 quarters, we expect a very healthy sequential growth, sequential organic growth in our services business. However, the market is still a little tepid on the discretionary spend. At the start of the year, we expected the discretionary spend would start coming back, partially at least, but with the continuing macros, the spending has not come back the way we expected. This quarter, as I announced, the telecom, media and entertainment segment has grown sequentially 6.2%, which is a very, very strong growth. We have no contribution from the strategic partnership that we have announced in Verizon, which is going to come from 1st of November as we had announced.
Right. Let's quickly move on. We also have a slew of brokerage notes coming in with regard to IT. Let's take a look on all of those brokerage calls trickling through. Vamakshi is here with the details on those. Vamakshi, take it away.
Well, yes, let me first start off with HCL Tech. The company reported its Q2 numbers yesterday and it was a mixed bag. In fact, when we look at some of the brokerages that they are the guidance cut that the company announced was on expected lines. But what was unexpected was the margin beat. The company posted a positive margin surprise and in fact the margin expansion was higher than what the street was anticipating. But nevertheless, it has in fact lowered the outlook like for peers. They have definitely a better stance on the second half of the year as far as their performance is concerned. Now, HCL Tech, we have a couple of brokerages here. Goldman Sachs has maintained its neutral rating, likewise for UBS as well as Bank of America. For Goldman Sachs as well as UBS and Bank of America, they've gone ahead and hiked their target price on HCL Tech, while JP Morgan has maintained an underweight call with a target price of 1,070 rupees per share. Apart from that, let's also focus in on Infosys. The brokerages are saying that the FY 2024 guidance cut was a negative, but there is no change to the FY25 outlook. There are some very strong deals and these provide comfort on the FY25 growth. Near term is expected to be weaker, but they have a very strong long-term potential. Most of the brokerages have in fact gone ahead and lowered their revenue as well as EPS estimates. In fact, we have several brokerages, Goldman Sachs as well as Jefferies, maintaining a buy rating on Infosys, given a target price of 1,620 and 1,650 respectively, while JP Morgan and Bank of America have a neutral rating on Infosys. So on the back of these brokerage notes as well as their results, keep an eye out on HCL Tech as well as Infosys.
Absolutely, Vamakshi. Thanks so much for taking us through that. Well, Infosys ADRs were also down 7% in trade yesterday post-market hours. So, well, that should reflect upon how that stock is going to open up for us this morning. Let's see how all of these three stocks open up on the back of their results. Now, shifting focus to banking, then we've got word coming in that RBI has taken action against Bank of Baroda after the bank accepted lapses in linking of mobile numbers to its app. ET now has learned from sources that the regulator has verified various complaints from whistleblowers before taking this action against the bank. Ankur Mishra has more details on this exclusive story. Ankur, take it away.
Yes, sources say that Reserve Bank of India action on Bank of Baroda has been taken after there has been several complaints regarding BOB World app. The allegations were that the mobile number linkage with the app was not proper, the process was not proper, and hence several whistleblowers had complained regarding the same, that there are few instances in some branches where the inflated numbers are there on the mobile app, which is BOB World, and hence the action needs to be taken after there were several checks and balances which were taken by the bank itself after these complaints surfaced. But the bank has acknowledged that there has been few lapses in the process of onboarding new customers. This was acknowledged when even regulator checked about the same, and after that the regulator has taken the action of onboarding new customers on mobile app. But just to clarify, the problem is limited to be in some branches only as per the inspection which has been carried out by the regulator. So moreover, the magnitude of the problem is not big, but since there are lapses in the process itself, the regulator wants the bank to have a robust process of onboarding new customers, and hence as this action has been taken. Now bank is in discussion with the regulator for doing the same, and we may soon see that bank will reach out to Reserve Bank of India after the suggested changes in the process have been made.
Right, let's slip into a very short break. More, of course, on the other side. We'll continue to be stock specific. Right, welcome back. You're watching Market Cafe on ET now. We also had SBI come out with its note on UBS come out with its note on SBI. They've actually downgraded it to a sell from a buy, cut its target price from 740 to 530. Its first big downgrade on SBI to a sell in the last 3 years. So this one is a big one. What they're really expecting is that they're expecting return ratios to come off. Mind you, the return ratios or the ROA of SBI is roughly at 1.2%, expected to sustain their basis management commentary, but UBS clearly not confident on that one. What they also believe will be a big miss will be with regard to capital. They are saying that the CET1 is roughly at 10.8%, which leaves very little cushion with regard to regulatory tightening going forward. They believe that the stock has underperformed the bank Nifty, or rather has outperformed the bank Nifty, again apologies, since February of 2020. So what they're suggesting is that this outperformance is not expected to sustain over a longer period of time. They've cut the target price, and which incorporates EPS cuts both in FY24 and FY25, and they're expecting a 20% contraction in the target price to book value, which currently stands at roughly 1.3 to 1.4 times. So on the back of that, what they're expecting is they've given it a target price of 530, so a 10% downgrade from here, Snehi.
Absolutely, Harsh. So, well, that is UBS downgrading SPI. But let's keep it with the brokerage notes then. And Nuvama has maintained a buy on NMDC. Incred has also given a buy call in a pair trade. So, I'm being joined in the studio by my colleague Ashesha. Ashesha, break down these notes for us and take us through the key highlights.
Well, yes, after the sharp run-up that we saw in mining stocks yesterday, we have two notes that have come in on NMDC. Nuvama first up, they've maintained their buy stance on the stock, but they've hiked their target price from 143 to now 188 rupees per share. They say NMDC is in a sweet spot to cater to the rising demand of iron ores. Globally, prices are on a rise and they expect domestic prices to rise from here on. They also believe that the company could pay a dividend of 15 rupees per share in the second half of FY24. They say that they have raised their EBITDA estimates for FY24 by 23% and for FY25 by 20%. So strong upgrade that has come in from Nuvama. Meanwhile, Incred has also come out with a note. They've initiated a pair trade on two counters. So basically sell rating on Coal India and buy stance on NMDC. They say Coal India's e-auction realizations, which is the main driver of profit for the company, is expected to decline from here on. Iron ore prices, meanwhile, are rising. Iron ore volumes are also expected to surge from here on, and hence a sell rating has come in on Coal India with a buy rating on NMDC. They say that iron ore will remain in short supply in India, while Coal India is ramping up production in an already oversupplied market. So on the back of both of these two brokerage notes that have come in on NMDC, this counter will be in focus today.
Right, thanks for that, Ashesha. But also talk to us about all the other stocks that will be in focus, buzzing and in news today.
Well, yes, apart from IT companies, a whole host of counters will be buzzing to their results, which they reported yesterday post-market hours. First up, let's talk about Anand Rathi. Strong set of numbers. Numbers largely were steady, but the management commentary or the guidance is quite positive. Revenue has risen by about 29% on a year-on-year basis. Margins have come in at 42% versus 40% same time last year. And profitability has also improved significantly by 38% on a year-on-year basis. Anand Rathi, meanwhile, largely inline set of numbers. Revenues are up 4% on a quarter-on-quarter basis. They've raised their AUM guidance for the full year from 47,000 crores earlier. Now they've raised it to 51,000 for FY24. And as far as revenue and PAT guidance is concerned, they've raised their revenue guidance to 720 crores for FY24 and PAT guidance to 224 crores. On the back of guidance upgrade that has come in, Anand Rathi Wealth will also be in focus today. Meanwhile, SJVN, on the back of an order win that has come through, the company has informed the exchanges that they are in receipt of letter of award for development of 100 megawatt solar project. This is from Rajasthan Urja Vikas Nigam Limited, and the project cost stands at about 600 crores. So on the back of this order win that has come through, keep an eye out on SJVN as well. Meanwhile, Dr. Reddy's, where the company has received 9 observations in Form 483 from US FDA for Hyderabad Biologics Manufacturing Plant. Emphasis will also be in focus, and this is on the back of an acquisition. The company said that they've acquired Salesforce partner Sonic. This is a $132.5 million acquisition. Keep an eye out on this counter as well. Lastly, Avalon Tech, lock in on 50% equity, ends today. Perhaps some selling pressure on this counter. Keep an eye out on Avalon Tech as well.
Right, thanks so much for that, Ashesha. We will keep stock of those counters. But very quickly moving on, we have HDFC Life expected to deliver its numbers today. Q2 numbers expected 8% growth on both APE as well as VNB, expected slightly higher base also. We're also seeing VNB margins which are expected to expand. Now mind you, margins have been tricky for HDFC Life largely on the back of the fact that because there's a merger that's been at play between HDFC Life as well as Exide Life, and therefore margins took a bit of a knock momentarily for a few quarters, and therefore you're seeing a slightly lower margin number, but 26.5% is where that margin number is expected to be, 70 bips higher than the 25.8% it clocked same time last year on the merged entity. Let's also look at what could be key with regard to commentary. Growth commentary going forward will be key. How the product mix is shaping up, well, the expectation is that it's going to be healthy and they are going to be more focused on both annuity as well as non-par, which will aid VNB margins as well going forward. But some of those metrics are going to be important from a monitorable standpoint and from what commentary comes in from the management. So keep your eye out, HDFC Life, and focus on the back of that.
Absolutely, keep a close eye on that stock in today's trading session. But with that, we're completely out of time on this week's edition of Market Cafe. Wishing you a nice trading session ahead and a good weekend ahead. It's a goodbye from me and Harsh and the team that put this show together. But you don't go anywhere because the market will take all the action ahead.